The world is going GameStop mad. The internet has finally found a way to beat Wall Street at its own game, and the world of investing has changed forever. Or has it? What is going on YouTube? Welcome back to the channel. I know a lot of you are new here, so make sure you subscribe to the channel to see more videos like this. This video is for those of you who aren't professional investors and you want to learn a bit more about what on earth is going on with this whole GameStop stuff. Keep watching if you want to learn in basic English about the fiasco all over the news, about the GameStop share price going to the moon, about retail traders taking on Wall Street and hedge funds, and about shorting and this thing called a short squeeze. Feel free to skip around the video using the timestamps in the video description, and if you enjoy it, do consider giving the video a thumbs up. So without any further ado, let's get straight to it. Let's take it back to 2002 when GameStop went public. GameStop is an American consumer and electronics company, and so in the last few years, given the pandemic and given the movement of gaming online, GameStop as a company has been suffering. They lost around $800 million in 2019 and they're expected to lose around $100 million in the next year or so. And so naturally, a ton of hedge funds did their research and realized that the future doesn't look too bright for this company. And when you have such a view on a company in the world of trading and investing, you do this thing called shorting or short selling. When you like a stock, you go long. You buy it at X and hope to sell it at Y, and then you profit the difference. Simple. What if you don't like a stock and you think the price is gonna go down? You do the opposite of long, you go short. To short a stock, you do the following. You borrow a stock, or as many stocks as you want, from a friend or a broker. So you borrow that stock and you say to them, yo, I'll give this stock back to you in a week or a month and I'll give you some interest for your trouble. So you give them a fee on top, right? So you've got this stock and you think that this stock's price is gonna drop in the next week or month, however long it might be. And so what you do, you take that stock and you sell it in the financial markets. So you get some cash. Let's say you got $10 for that stock, and then a week goes by and to your surprise, the stock price dropped. So now it's worth $5. So you go back into the market, you buy that stock back for $5, you return it to your friend and you give them $1 interest or whatever it might be, and then you keep the profit. The stock price went down to $5. You use $5 from that $10 to buy it back. You give it back to your friend and then you give them $1 fee, and then you keep $4. That's your profit. Now, if you amplify this into the hundreds of millions or billions, you can see how a lot of hedge funds and a lot of traders are making their money shorting stocks. Now, this is all well and good if the price moves in the direction that you predicted. However, if the price goes in the opposite direction, it's gonna be a nasty burn for you, and we'll go into that in a bit. Now, it's important to understand that the nature of hedge funds is to take levered bets. This is a fancy way of saying betting huge by borrowing money, so using debt to amplify the size of your trades. When they're correct in their investment ideas, it means they make a shitload of money. However, if their ideas don't go to plan and the market moves against them, it means they can lose a lot of money. And that's why you see and hear of lots of hedge funds getting closed down, because they took on huge bets, levered bets, and they ended up losing badly. So you've got all these hedge funds shorting the GameStop stock, hoping for it to go down. And then this is where it gets a bit weird and interesting. Enter the subreddit Wall Street Bets. Wall Street Bets is a subreddit on the online social discussion platform Reddit. They've got over 8 million followers, or as they like to call them, degenerates, and they like to discuss all things trading and Wall Street related. Most of Wall Street Bets followers aren't professional traders who work on Wall Street. They're individuals like you and I who are actively trading in the financial markets, and they use their own money and they don't work for a large bank or a financial institution. So the big hedge funds have done the research, analyzed GameStop, and they thought, all right, let's go short this stock, drive the price down, make millions if not billions for ourselves and our clients, and then move on to the next one. However, a few traders on Wall Street Bets did their own research and they realized that a few hedge funds were shorting the hell out of the GameStop stock. And so they were like, wait a second, we've got an army of retail traders on Wall Street Bets who despise hedge funds and despise Wall Street and the establishment. And so wouldn't it be jokes to play them at their own game just for the bants? And so that's exactly what they did. So the idea gets pitched on the subreddit Real Wall Street Bets and it starts gaining traction. Before you know it, the $10 GameStop stock starts climbing in value as opposed to going down. If you want to try your hand at investing, you can get a free share worth up to £200 by using the link in the video description. If you do that, we'll both get a free share worth up to £200 and you can start investing in the markets for as little as £2. It's a failing business. The fundamental research points towards the stock price declining. However, it's going in the complete opposite direction. It's going up. And the reason for that is because a large number of retail investors are buying the stock, and due to supply and demand, when you buy something, there's more demand for it, and so naturally the price increases. This is then compounded by the effect of social media, Instagram, Twitter, LinkedIn, Facebook. Everyone's talking about it, and so it becomes a David versus Goliath kind of story. Retail traders taking on hedge funds and Wall Street, and retail traders actually winning. More and more people jump in because to buy the stock is easily accessible, it's cheap, and they do it just to take the piss out of the hedge funds. And then none other than Elon Musk tweets about it. This drives the share price up even more. And so when it started off in the beginning of January at $17, before you know it, by the end of January, the stock price increases to over $345, which is mad. You know, with all the social media platforms out there, I think Twitter is where it's at. All it takes is a tweet from Elon Musk or a Chamath Palihapitiya to tweet a name of a company, and then you'll get millions of people buying the stock, and it just influences the market like never before. And this is happening more and more, and it's going to continue to happen. All right, so Elon Musk tweets, there's lots of social media interaction, the story's popping off. So what happens next? The professionals on Wall Street and the hedge funds have done their research. They've done the fundamental analysis on the company. Everything about the company, it's out of date. It's not got an online presence, its business structure, whatever it might be, all the fundamentals are pointing towards a declining stock. However, what's going on with the stock price is going completely against what fundamental research says. It's going up instead of down. And this is because of the influx of retail investors or money going into the company's stock price, driving it up. You can have a view on a company, whether it's doing good or bad, because of its new CEO, because of its company structure, because of the products and services that it offers. But in this day and age, a lot of that can go out the window, especially when you've got influential people tweeting, or you know what's going on in the social media space, or Wall Street bets in this case. And so that can drive the fundamentals out of the window and influence the price in a completely unexpected way. Personally, I don't think it will be sustainable in the long run, because those who got in early and bought at 10 will see it go to 300 and then think, all right, let's call it a day, let's cash in our profits and leave. When people start selling at 300, the price will start trickling down naturally over time, and so it won't be sustained and it won't increase forever over the long run. So the Wall Street bets traders buy lots of stock in GameStop, and this drives the share price up. Now at the same time, you've got hedge funds with billions of dollars of contracts in shorting the stock, and so they're kind of like, oh shit, the bet is going against what we predicted. It's not going down, it's going up. Remember, the hedge funds want the price of GameStop to go down from $10 to say $5. Instead, what's happened is the GameStop price went from $10 to $300. Now, what this means is, let's say you borrowed a stock from a friend for $10 and you said you'll give it back to them next week. You're hoping to buy it at $5 and then give it back to them. What's happened is now you need to buy it for $300 and give it back to them. And so you're like, holy crap, $300, I didn't expect this. And you're legally obliged to get them that stock back because you've tied into a contract. On top of that, you need to pay them some fees for borrowing that stock. And so the hedge funds are taking next level losses. Remember, they lever up as well. They take on leverage, and so their trades are amplified because of this leverage. And so they're facing millions, hundreds of millions, if not billions of dollars of potential losses. And this is what happens next. It's a thing we call the short squeeze, the infamous short squeeze. A short squeeze, in simple terms, is when you take a short position and you predict the stock price to go down. However, the stock price starts increasing. A short squeeze is forcing you to buy it at 100 or 200 or 300. If it goes to 400, you're going to be in further debt. You're going to need to buy at 400 and give back to the person you owe. And so a short squeeze forces you to sell out of a contract, out of a short contract, because the price went in the opposite direction that you wanted it to. You can hold on to that contract because you went in at 10 and you think it will come back down, but you run the risk of the price continually going up, and so your loss is getting bigger and bigger. And so this is what happened to a lot of hedge funds. They bought in, let's say, at $10. They wanted it to go down to 5. A lot of the Wall Street bets traders bought the stock. It started going up. It went to 100. Some hedge funds exited at 100. It went to 200. A few more hedge funds exited at 200. It went to 300. And so all these points is a short squeeze on the hedge funds, forcing them to close their positions and exit out of GameStop. And so the price kept going up. That is basically a short squeeze explained in less than a minute. If that made sense to you, it's quite complex, but if that made sense to you, I need you to give the like button a short squeeze. And if you want to go long on this YouTube channel, make sure you hit the subscribe button. See what I did there? Now you might be thinking, why didn't the Wall Street bets traders get in at 10, raise it to 100 and then exit, profit and leave? But a lot of this was sending a message to Wall Street and the establishment and the hedge funds. People wanted to just buy and hold and then let the hedge funds suffer as big losses as possible. So now a lot of retail investors have gone online, they've done their research, and they're looking at heavily shorted companies by hedge funds such as AMC, BlackBerry and others, and they're beginning to speculate on those companies. More than anything, it's to send a message. It's the classic David versus Goliath. It's the masses versus the 1%. And so when you've got 8 million followers on a subreddit, it's a very powerful movement. However, things started getting a bit sour. This brings me on to Robinhood, which might need to be a video for next time. But Robinhood, which is an app that lets people buy and sell stocks, started to stop people from buying shares in GameStop. This didn't go down too well. After all, Robinhood was meant to be for the people. Instead, a lot of people were thinking it's backing the hedge funds because it was backed and receiving money from one hedge fund in particular. There were two main arguments. One side was saying this whole thing is market manipulation. You've got droves of, followers on Wall Street bets, and you can't just come together online and agree to buy a stock and drive the price in a way which favors your investment. This is market manipulation. And then the other side was saying, wait a minute, this is what hedge funds have been doing for decades and how they've been outplaying and bullying the retail investor. Just because they have private dinners in Michelin star restaurants, why are they allowed to get away with it? Worst of all, when they mess up, they get bailed out. To move markets, you need a lot of money. 70 to 80 million shares of GameStop were traded at one point in all of this. And so there's been speculation that maybe it's not just retail investors doing this. Maybe there are financial institutions behind a lot of the price moves and the GameStop price increasing. Maybe it's the institutions themselves that are riding the wave and increasing the price of GameStop. Personally, I'm not invested in GameStop. If you do consider investing in the financial markets, it goes without saying, do your research and approach it with caution. Understand that all of your money that you invest is at risk. Any money that I do invest, I do so expecting to lose it all. It's money that I'm willing to lose. Once it's invested, I see it as gone. If you enjoyed this video, let me know in the comments below. Do consider subscribing if you haven't already, and hit the like button to help the channel grow. Thanks for staying to the end, and I will see you in the next one. Peace.